Welcome to This Explainer. Today, we're cutting through the noise and diving straight into the Jio Platforms DRHP to figure out exactly how India's digital giant is financing its massive scale. We're putting everything else on the back burner to focus entirely on one crucial thing, the balance sheet and leverage.
Let's kick things off with a number that, well, it might make any retail investor do a double take. As of March 2026, Jio Platforms reported total borrowings of over 707 billion rupees. Yeah, billion with a B. When you see a number that massive, it absolutely demands a closer look.
So this brings us to the ultimate question we're answering today based strictly on those DRHP disclosures. Is this mountain of debt a calculated high-octane growth engine? Or is it a hidden structural vulnerability just waiting to create financial pressure down the road?
To figure that out, we're going to peel back the layers of Jio's financial anatomy across 6 key areas. We'll look at the balance sheet at a glance, break down Jio's debt, compare cash versus gross debt, check out interest and debt maturity, figure out why Jio borrows in the first place, and wrap it all up with a 3-year financial scorecard.
All right, starting with part 1, balance sheet at a glance. Let's map out the trajectory of Jio's total borrowing to see exactly where these numbers are heading.
Looking at the 3-year trend, you can see total debt sat at roughly 543 billion rupees in fiscal 2024. Then, whoosh, it jumped significantly in fiscal 25 to over 730 billion before just dipping slightly to around 707 billion in fiscal 26. Now, because total borrowings peaked and then kind of leveled off, we really need to look closer at what actually makes up these obligations.
Which brings us to part 2, breaking down Jio's debt. We need to shift our focus to the actual composition here, because, as you know, not all debt is created equal.
The DRHP reveals something super interesting. The vast majority of Jio's debt is classified as non-current. Out of that 707 billion total, over 514 billion rupees are non-current borrowings, leaving current borrowings at a much smaller 193 billion. In plain English, this means the bulk of Jio's debt is made up of long-term obligations. We aren't looking at immediate short-term pressures that need to be scrambled for and paid off within the next 12 months.
And this right here brilliantly illustrates exactly where that debt sits across the company. Straight from the DRHP, you can see the material subsidiary holds the vast majority of these funds. Check out the major allocations. Massive unsecured term loans and external commercial borrowings, or ECBs, heavily dominate the mix. Now, importantly, the DRHP notes that these credit facilities in India are typically unsecured. That means they aren't directly tied up with specific assets acting as collateral.
Moving on to part 3, cash versus gross debt. Calculating the true debt is essential, because looking at a company's financial health purely on gross debt is kind of like only looking at one side of a scale. To find the actual weight of this debt, we have to calculate the net debt. Step 1, we take our total borrowings of 707 billion rupees. Step 2, we subtract Jio's absolute war chest of cash and marketable securities. The DRHP lists this at an incredible 432 billion rupees for fiscal 26. When we run that formula, essentially asking what would they owe if they emptied their cash reserves today, the actual net debt drops dramatically to roughly 276 billion rupees.
All right, part 4, interest and debt maturity. Having established the true net debt, we've got to understand the cost of carrying it and, when the bill actually comes due.
The DRHP explicitly points out that Jio is heavily exposed to floating interest rates. Looking at fiscal 26, their non-current floating rate debt was over 554 billion rupees, compared to just 14.5 billion in fixed-rate debt. Because their interest payments literally float with the market, it mathematically explains why their finance costs climbed so much, hitting over 86 billion rupees by fiscal 26. But when did they actually have to pay the principal back? Well, looking at the maturity timeline disclosed in the filings, Jio has strategically staggered its repayment obligations. Working capital and overdrafts due within a year. Term loans are spread out between 1 and 7 years, their ECBs have an average maturity of 5 years, and bank guarantees stretch out up to 10 years. By staggering these dates like a ladder, Jio avoids that dangerous bottleneck where too much debt comes due all at once.
It is also really important to note that beyond traditional loans, Jio carries lease liabilities. In the telecom world, this generally means long-term rental commitments for infrastructure, like towers or fiber. The DRHP explains these are valued as right-of-use assets and lease liabilities, which are discounted using the interest rate. So while they are strictly accounted for separately from conventional borrowings under accounting rules, they are absolutely a very real part of their long-term financial commitments.
Which takes us to part 5. Why does Jio borrow? Let's see how these unsecured credit facilities actually build into their operational strategy. Spoiler alert, they aren't borrowing just to keep the lights on. The DHRP attributes these borrowings directly to fueling their ordinary course of business. This primarily means heavy capital expenditures for infrastructure, aggressively expanding their vast fiber network, securing network equipment, and managing day-to-day working capital needs. Essentially, they're borrowing to build out the very assets that generate their revenue.
And finally, part 6, the 3-year financial scorecard. To bring all these disparate figures together into one clear picture, let's assess their overall financial health.
These metrics objectively prove a massive deleveraging trend. Just look at net debt. It shrank from $484 billion in fiscal 24 down to $276 billion in fiscal 26. At the exact same time, EBITDA, which is a great proxy for their operating cash generation, surged from roughly $549 billion to over 762 billion rupees. So, because debt went down while cash generation went way up, their net leverage ratio was driven down from 0.88 times to a highly comfortable 0.36 times.
So let's bring this all back to our core investor question. Based strictly on the facts, the numbers, and the ratios detailed in the DRHP, does Jio possess the balance sheet strength to fund its aggressive future?
The data clearly demonstrates that yes, they do. Their accelerating cash generation easily absorbs the higher interest costs of that floating rate debt. Because their debt is overwhelmingly long-term and unsecured, and their cash reserves are just massive, they've created a highly liquid bedrock. This gives them the capacity for continuous investment without staring down any sort of imminent debt crisis. This leaves us with a fascinating final thought to ponder. At this rapid rate of deleveraging, dropping from 0.88 to 0.36 in just 2 years, how quickly will this digital ecosystem evolve from a heavy borrower building its foundation into a pure, unencumbered cash-generating machine? Based on the balance sheet, that transition is already well underway. Thank you for joining me for this explainer, and as always, keep questioning the numbers.